DeFi is moving fast. So fast, in fact, that projects you never heard of a few weeks ago already have hundreds of millions of dollars locked up into them. Other projects that were once dying have merely slapped that DeFi sticker on them to take them off life support. However, there are a few projects that have been there before the hype and hysteria, in a time when farmers grew wheat and didn't chase yield. One such project is Synthetix, a project that I've covered in the past. So, in this video, I'll be diving back into Synthetix. In it, I'll cover the tech, growth and updates, adoption potential, and regulatory implications, if any. And of course, I'll be taking a look at the tokenomics of SNX, its price potential, as well as a pretty neat way to generate some free SNX. So be sure to stick around for that. Now, before we dive into the DeFi waters, we need to make sure you don't drown. Firstly, you need to be aware that I'm not a financial advisor. I am a crypto guy, literally, that's here to share juicy educational content with you. Nothing more and nothing less. Oh, and for those that are new to the channel, allow me to introduce myself. My name is Guy, and over here at the Coin Bureau, we dig into everything crypto. News, reviews, and detailed coin overviews. If this is something that you'd like to avail yourself of, then please do hit up that subscribe button. And if you turn on those notifications, then YouTube will ping you a message whenever I release another video. And finally, I've provided these handy timestamps right here, so feel free to jump around to different sections of my analysis. Okay, all set? Let's get this show on the blockchain. So, what is Synthetix? Well, it's a decentralized synthetic asset issuance protocol that was built on the Ethereum protocol. This basically means that users are able to mint synthetic representations of real-world assets as tokens, which track the value of said asset one for one. So, for example, you have a token called SUSD, which is a synthetic token that tracks the US dollar like a stablecoin. However, unlike a stablecoin, it's backed up by collateralized crypto debt and not fiat in a bank account. Therefore, you can think of it as much the same way that you think about MakerDAO's DAI. However, SUSD is only one of a veritable smorgasbord of different synthetic assets that have been minted on the platform. We're talking crypto like Bitcoin, Ether, and Link, commodities like gold and silver, and even equity indexes. Pretty mind-blowing. Now, despite them being one of the first crypto projects to issue synthetic assets, this is actually something that's been around on Wall Street for some time. Quite simply, a synthetic asset is one that's been developed in order to track the performance of an actual asset. You have synthetic bond funds, equities, etc. However, the main difference with the Synthetix platform is that these synthetic assets are all issued in a completely trustless and decentralized manner. Users will collateralize or lock up the Synthetix network token into their minting smart contract, and it will issue these decentralized synthetic assets called Synths. All of these Synths are backed up by this overcollateralized pool of SNX tokens. This pooled collateral model enables users to perform conversions between Synths directly with the smart contract, avoiding the need for counterparties. This mechanism solves the liquidity and slippage issues experienced by DEXs. Another pretty neat thing about these synths is because they're synthetic assets, you can also issue what are called inverse synths. These will move in the inverse direction of the asset in question. So you can kind of view it as shorting the asset. What's also important to note about the Synthetix platform is that it's highly over-collateralized. The collateralization ratio on the network is currently 721%, which means that you have a lot more SNX backing up all the synths. This provides for a large buffer in the case of extreme price movements in the synths or the SNX token. I'll cover this minting process in a bit. Now, I know what you're thinking. How do the synth assets maintain that peg? Well, it comes down to two factors. Firstly, you have the principle of no arbitrage. This basically means that if there's a mispricing in one of the synths, then a trader is able to make a risk-free profit and eliminate that mispricing. So, taking a look at an example, an SNX staker has created debt by minting SUSD. If the peg drops, they can now profit by buying SUSD back below par and burning it to reduce their debt, as the Synthetix system always values one SUSD at $1. Then, another factor which helps to maintain that peg quite effectively is the open market liquidity for synths on other decentralized exchanges. For example, there are some pretty large pools for these synth assets on the likes of Uniswap. When there's more liquidity for the asset, then there are more traders who are going to arbitrage away those mispricing and maintain that peg. Now, I don't want to get too deep into the weeds here. I've linked to the white paper below, which goes into it in a bit more detail. I want to move on now and take a look at some of the other main features of the platform. Firstly, we have that mint adapt that I talked about. This is a pretty intuitive mechanism that allows those SNX holders to mint and stake their synths. When that's done, it also allows you to manage your collateral ratio and, when you want to withdraw your SNX, burn those synths. I've used this plenty of times and find it pretty damn simple. All you need to do is connect to the dApp with a Web 3.0 wallet and you can effortlessly interact with it. Then, as mentioned, you have that Synthetix decentralized exchange. This is much like many other DEXs out there in that it allows you to switch one synthetic asset for another in a completely decentralized and trustless manner. This was one of the first places that these synth assets began trading, but as mentioned, they're now listed on a number of other DEXs. I won't go into the details of the exchange here, as I covered it in more detail in my previous video. You can watch that right here. Oh, something else that you may want to know is that Synthetix has released a binary options platform. These are basically options that have a binary outcome depending on whether they're in or out of the money. What's pretty neat about this is that it's perhaps the first decentralized exchange that I've seen that lists option instruments. And even on the centralized exchanges such as Deribit and OKX, these options are only on assets like Bitcoin and Ether. Over at Synthetix, you can trade binary options on all of these bad boys right here. Okay, so those are the main features of the Synthetix platform. They allow for the creation and trading of these synth tokens. However, something else that's central to Synthetix is, of course, that SNX token. So let's take a look at that, shall we? SNX is an ERC20 token that was initially issued to investors in a number of private and public sales back in early 2018. For those that can hark back to those days, the project was initially called the Haven Protocol. During all of these rounds, they were able to sell a total of 100 million SNX tokens in exchange for $30 million. These tokens issued in the ICO were meant to be the max supply. However, in March of 2019, a new monetary policy was introduced. This was in order to provide a regular staking return to those who staked their SNX. You can see the inflationary policy in the following schedule over here. Initially, it was proposed that there would be a fixed supply point at which time inflation would approach zero. However, in December of 2019, they pushed an improvement proposal that changed it one more time. This introduced a fixed inflationary percentage into perpetuity. So, the inflationary structure will conclude in September 2023 at a supply of roughly 250 million SNX. Once this is reached, inflation will be a fixed 2.5% annually. You can see how the new inflation schedule looks like compared to the old over here. So the main takeaway here is that staking returns are larger the earlier in time that you decide to stake. As we approach the end in 2023, those staking returns will drop down to that 2.5% level. Now, in order to determine the value of the token, we have to consider the use cases. The primary use case of SNX is as a staking token. Let's not forget that in order to mint those synth tokens, you have to lock up some SNX in the Mint dApp with a target collateralization ratio which is currently 600%. The main benefits that come from this are twofold. Firstly, you have the rights to that fixed monetary inflation that comes through the staking rewards that I just talked about. This is currently about 43% using this handy calculator here. Of course, you have to consider that there is protocol inflation, which does reduce the real rate of return, so just be aware of that. Either way, this puts you in a way better position than anyone who holds SNX and does not stake. Your holding is being inflated away at a pretty high rate currently. This is also great as it does encourage staking participation and with it, network security. Anyways, While staking returns is one incentive for those who want to stake their SNX, you also have additional return potential from those trading fees. You see, when Synths are traded on the Synthetix exchange, they incur a 0.3% fee. These fees are then collected and distributed to those staking SNX proportional to the amount staked. So, if there's a lot of activity on the Synthetix exchange, then this means a lot of fees which are then paid to those staking SNX. Oh yes, and there's one more SNX use case which is likely to be introduced in the not too distant future. This is the potential to take part in the decentralized governance of the protocol. As Synthetix moves to a completely decentralized entity, the token holders will have a say on the direction of the protocol. Now, being able to value this governance component is a lot harder than many of the others, but there is value of some sort. You only need to take a look at the craze of these DeFi tokens like Comp and Wi-Fi that do nothing but confer governance rights. Okay, so let's put all of this together. On the demand side, you have demand to stake and earn those trading fees and staking rewards. You also have demand to have a vote in the governance of the protocol. On the supply side, you have decreased supply as those who are staking are taking it off the market. However, you also have to consider the inflation of new SNX going to the stakers. Right now, it's hard to determine which forces are likely to dominate. However, when we reach 2023 and inflation falls to 2.5%, I think that demand will fundamentally outstrip that supply. Of course, markets are not as clean-cut as simple economic models suggest. There are often other factors at play that drive demand to astronomical levels. As you can see from the SNX chart over the past 6 months, prices have been steadily increasing. While it's not rallied as much as some other DeFi tokens, it's still up a mere 7.5 times since I covered it in February. So what is driving this? Well, clearly the DeFi craze is a large component of this. You only need to look at the amount of dollars that have been locked into Synthetix since the beginning of the year. But then there's also what one could expect to come. Synthetix have just launched options on their platform and are looking towards listing leverage trading and decentralized futures. All of this will drive demand for the exchange, which will drive trading fees and hence returns for stakers. Then you have to consider that decentralization move. If Synthetix is able to fully pull that off, then it will further bolster its position as a leading DeFi DEX. There is one other thing you may want to consider. That is that Coinbase seems to be lingering in the background. Yes, in June of this year, the foremost centralized exchange stated that they were considering SNX for a listing. The token was on a list of other tokens that were considered for that listing. Of course, I don't need to explain what the impact of a Coinbase listing has on the price of a token. For example, both New and Compound Finance were in that Coinbase post and both rallied like crazy post-listing. Perhaps this potential is priced in. Hard to tell, but you can't deny that it's a factor. You also don't have to look far to get further optimistic projections. For those of you who follow Weiss ratings, they recently released a report that was pretty bullish on the prospects of SNX. They listed a number of factors, most of which I've covered here. They also had their own conservative price prediction for SNX to triple by the end of the year. Given the current price level, that would mean an end-of-year price of about $15, something which I view as pretty realistic. Now, when it comes to the current market for SNX, it's quite well supported. Not only is there oodles of liquidity over on Uniswap, but it's also listed on a number of centralized exchanges, including Binance and OKX. So if you wanted to pick up SNX, you could easily do so there. However, as mentioned in the intro, there is a way that you can generate yourself some free SNX, and that is through a process called liquidity mining. Basically, in order to incentivize external liquidity for the Synth tokens, Synthetix has provided for weekly SNX rewards. You can see exactly what those potential rewards are inside your Minter dApp. If you head on over to the LP Rewards tab over here, they list all of the pools they're distributing these rewards from. I'm actually also supplying liquidity for one of these pools, and that is the S Bitcoin pool on Curve Finance. This liquidity pool consists of 3 tokenized Bitcoin, including Wrapped Bitcoin, Ren Bitcoin, and of course Synth Bitcoin. Now, apart from the ability to earn some of those weekly rewards of SNX, there are a number of other reasons why I'm supplying liquidity to this pool. Firstly, it allows me to generate returns on my idle Bitcoin while keeping exposed to it. Over at Curve Finance, you earn fees when trades are done in the pool you're supplying for. This means that I'm earning some of those fees and I still have the potential to take part in additional Bitcoin upside. Then, because this is a joint pool between Synthetix and Ren, it means that I'll also be getting Ren token rewards. Not only that, but both Balancer and Curve are throwing their own rewards into the mix as well. Quite the kicker. Now, I won't go into the mechanics of how this works here. If you want to learn more about this synthetic Bitcoin pool, then I encourage you to watch my video on yield farming right over here. Of course, there are a number of other pools that you can join. If you prefer to keep the dollar value of your holding, then you can supply SUSD liquidity on Curve, for example. Okay, so that's liquidity mining some free SNX. I want to move on to another question that I'm sure many people will no doubt be asking. What do the regulators think of all this? The reason that this is an important question is that what Synthetix is doing is providing a market for synthetic securities. This falls squarely into the purview of the SEC, and those entities or platforms that do not register with the agency are operating against the law. This is something that many a crypto company has come to realize. The most recent example of this was the Abra crypto investment app. This was a platform where users could trade synthetic, traditional assets like stocks by putting up cryptocurrency. In this case, because they were offering security-based swaps, they were not only standing on the toes of the SEC, but also the CFTC. Well, neither agency took kindly to that, and they charged Abra for operating illegally without a license. Abra agreed to a cease and desist order and settled fines of $150,000 for each agency for a $300,000 total. It's also important to point out that Abra is not even based in the US. They're based in the Philippines, which shows how far the long arm of US law enforcement can reach. I happen to remember a similar situation back in 2018 when the SEC shut down one broker and seized their domain. This was a Bitcoin-funded broker that offered swap trading, and they were based in the Marshall Islands of all places. So people will naturally wonder where Synthetix lies on this legal line. Indeed, it's a question that many have pondered on forums and in other news articles. It's something that many of my viewers have raised in my previous Synthetix video. Well, most will point to the fact that Synthetix is decentralized, and hence there isn't really anyone to target. Both of those previous examples had a centralized company or individual which could be sued. But the important question for Synthetix and other DeFi protocols is it decentralized enough? Yes, the smart contracts are on the Ethereum blockchain and users are trading amongst themselves, but there was a foundation that completed an ICO and which owns the Synthetix domain. Could this have been a central point to target for the SEC? That's something that's completely unknown. The law is clear on it, but given the nascency of cryptocurrency, there's no precedent on how to deal with decentralized networks. However, according to a quote in this article from Josh Garcia, a partner at a New York law firm, quote, "Developers who create a market for synthetic securities are playing with fire, period." I was therefore quite encouraged to learn that in December last year, Synthetix was taking the step of a full transition to a decentralized governance framework. And then in July of this year, the foundation was completely decommissioned. Going forward, there will be 3 DAOs, decentralized autonomous organizations, that will be taking over. These will be the Protocol DAO, Grants DAO, and Synthetix DAO. Control of the admin keys will be in the hands of the Protocol DAO. Here there will be 8 individuals who control it, and the contracts will be secured with a 4 of 8 multi-sig wallet. Governance will also be controlled and voted on by the broader community who hold those SNX. This means it will be a much tougher case for the SEC or any other agency to chase. However, I don't really know the lengths that the man would want to go to in order to enforce their mandate. And while it's true that no one entity controls the platform, you still only need 4 signers on those contracts in order to gain admin control. Could they be a target? In all honesty, I don't happen to think so. But this is just my personal opinion. I am not a lawyer nor a financial advisor. I'm just a crypto guy who likes to ask a lot of questions. This video is getting long, so I'm going to quickly wrap things up. Firstly, I will say that I am a fan of Synthetix. Their technology is mind-blowing, and they've created a trustless ecosystem where traders can trade a range of synthetic tokenized assets, from crypto to stocks, commodities, and equity. I also like the fact that they've re-engineered their tokenomics in order to reward those who stake into perpetuity. This ensures that there's still healthy growth in the ecosystem even past 2023. Not only that, but they've created immense demand for the token in order to stake. Heck, SNX is so in demand that it's even used as an incentive to provide synth liquidity, something that many in the DeFi field have embraced with open arms. And there's a lot to look forward to. Not only have we had the launch of the recent binary options platform, but we could also see more margin trading alternatives as well as more involved decentralized derivatives. This all means further trading fees, further liquidity, further SNX stake, and, holding all other factors equal, a higher SNX price. Of course, we also need to be aware of the risks. While Synthetix is a highly overcollateralized ecosystem, tail risks do exist. Let us not forget about that Ethereum flash crash back in March that liquidated a lot of the MakerDAO vault holders. It's a very small chance, but that is exactly why these tail risks are called black swans. And speaking of black swans, that regulatory question does still linger. One can only hope that the Synthetix DAO ecosystem is sufficiently decentralized to be unstoppable. I mean, that is, after all, what DeFi and crypto are all about, right? Permissionless, censorship-resistant, distributed. Unstoppable. Okay, I got a bit carried away on that one, folks. Thanks for sticking in there. But I need some of your all-insightful feedback. What are your views on Synthetix? Do you have any questions for me? Hit me up below. And again, thanks so much for hanging on in there. If you found value from this video, then please do leave me a like. Also, don't forget to subscribe, as you won't want to miss what I have coming next. I hope you liked that video as much as I enjoyed making it. But truth be told, I just couldn't fit everything in that I wanted to. But if you subscribe to my weekly newsletter, then you can get all those tidbits and a whole bunch of other juicy nuggets of wisdom. Keen? It's actually pretty damn simple. All you need to do is ping over your email in the sign-up form below. Then you'll just be sent a confirmation link and you are locked and loaded. Oh, and I hate spam more than anyone, so you sure won't be getting any from me. Hope you folks enjoy the next email.